Welcome back. You're listening to Houston Real Estate Radio. I'm your host, Shannon Register. And last segment, we were talking with Dr. Jim Gaines from the Real Estate Research Center over at Texas A&M University. He's the economist over there, gives us lots of great information. If you've got a real estate question for us, you can give us a call, 844-788-9444. We're going to pick up here again with Dr. Gaines Skyping in just a minute. But if you have a real estate question, you can always call us anytime, 24/7. We'll answer your questions right here on the radio, 844-788-9444. All right, we ended the program, and I told you, Dr. Gaines, that I was going to ask you about that presidential election coming up in November. You know, before we talked about the elections, sometimes they affect the economy and sometimes they don't. What do you think about November? What can we anticipate as far as the economy goes and the impact from these presidential elections?
It looks like right now that the economic impact is going to be not as much as you would see in some other presidential elections, mainly because we don't have an incumbent running.
Okay.
Quite often when that happens, laws or rules get passed. Now the other end of that coin is without the outgoing president, administrator could decide to do something at the last minute that he has nothing to lose and politically.
Executive orders?
Executive orders, whatever. So it can work either way. But I know people ask me about the interest rate increase. We didn't get to that in the previous segment.
Yeah.
A lot of times the Fed has been reluctant to increase interest rates in the presidential election year, especially if there was an incumbent. Now, theoretically, technically, the Fed is independent politically from Congress and the president. Incidentally, as it should be, as it needs to be. But nevertheless, there's always pressure to bear. Nothing is totally independent. But for this year, we don't really anticipate economic impacts other than if the outgoing administration decides to do some type of unanticipated executive orders or something like, or they could work a deal. One of the issues that's been on the drawing board for the last several years is to do something on the fiscal side with the tax laws.
So as far as buyers go who are looking at purchasing a home in 2016, the earlier part of 2016 would be better than the latter part because of the interest rate increases, right?
Well, we know that obviously the Fed just a few weeks ago did increase it slightly. We don't anticipate the mortgage interest rate to respond that quickly to it. So I think during the course of the year, if the Fed does what it says it's going to do, that's an if, which is to increase interest rates again sometime during the year, as many as maybe one or two more step increases along the order of magnitude of what they've done. We might see long-term mortgage interest rate, the 30-year rate go up. We're guessing somewhere not much more than about 4.5% on the upside, and that toward the end of the year. At 4.5%, that shouldn't be such a discouraging issue. It's not that much. It's about 0.5 point more than roughly where interest rates are now. And so, yes, some people will be caught on the margin on that. May have to lower their price expectations a little bit, that sort of thing. The more important part on the mortgage side is the tightness or the looseness of the lenders in making mortgage loans available.
Yeah.
The lending function is moving away from the banks, as you well know, to mortgage companies, to the non-regulated, non-thrift institutions, i.e. the mortgage bankers, the mortgage companies, and that sort of thing. And this is a structural move in the mortgage market that, yes, is going to continue. They tend to be a lot easier, a lot looser, if you will, in making credit available and in the underwriting function than the banks might have been, because they don't have the reserve requirements. They don't have the regulators looking over their shoulder, telling them what they can do and what they can't do.
Right.
So I think what we'll see this year is it might become easier for some of the first-time buyers, the younger buyers, to get a loan in the first place in order to qualify. to get a higher loan to value ratio or a lower down payment requirement, even with a slightly higher mortgage interest rate. Although I don't think the interest rates are going to change all that much, other than what we've seen the last year or two, because they've always bounced around.
Right. I hear a lot from consumers about the prices of everything going up. Going to the grocery store has just become so expensive. I mean, everything is just so expensive now. You'll go into the movies, anything that you do, but gas prices are so low. And I just wonder, when gas prices go back up, we are really going to have an affordability issue. Do you agree with that?
Yep. Yeah. And now I'll tell you what the lower gas prices are doing, though, is helping the home builders.
Yeah.
Because the home builders, particularly building out in the suburbs and the further out communities, those communities now are more attractive to the buyer because the cost of commuting, wherever you're commuting to, is a lot less with a $1.60 a gallon gas instead of $3.60 a gallon gas.
Right.
So that is helping. It's ironic you said all that because I agree with you, and my wife, I'm sure, would agree with you. But the official numbers for inflation are virtually at zero. And commodity prices are coming down. Corn, wheat, cotton, all of the commodities are coming down. But I can tell you, ask the home builders, they'll tell you that their cost of production is going up.
Right.
Labor costs are going up, and their
concrete cost.
The concrete cost, even the lumber and drywall and other materials are going up. So it's a mixed bag on the cost side. But land costs right now are going to drive the housing prices up as well.
Yeah. So on affordability, for younger people looking to buy their first time home, now is probably preferable to future just because of price increases?
Yes, absolutely.
Okay.
I think that inflation expectation we were just talking about, anytime you expect prices to go up, you're better off to buy now than later, because later you have to pay more. And right now, prices are going up at a much faster clip than incomes are. For that reason, I would tell buyers, prospective buyers, and the realtors who are advising buyers, be a little leery of adjustable rate mortgages too. I mean, obviously you're expecting the interest rates to go up. So if you do get that adjustable rate, in the last several years, the rates have actually gone down. So your adjustable rate was a good deal because you've gotten a future rate that was lower. Although the entry rate for the adjustables is real low to start with. So it's going up. And if the prices are going up faster than income, then that your income, it might not keep pace.
When are we going to see the increase in salaries come back? That's what I want.
It hasn't happened yet. Well, I mean, it's happening in areas and some categories. Salaries and wages are going up, and others it's not. We've got actually a low unemployment rate, but we actually have a high labor force, effective labor force, a real labor force, because the official measures there are so screwy, you can't really rely on that unemployment rate.
Well, we talked a little bit about new construction. You think we'll still see a lot of new home starts in 2016?
I think the home starts will probably keep pace with 2015.
Okay.
The anecdotally, what I'm being told by the home builders, the constraining factors there has not been being able to sell the homes, it's being able to find the lots to build on, being able to find the labor to build the house, and it's being able to pass through the cost of the material cost and the land and labor cost.
Yeah.
So, but the demand is still strong enough, at least here for the first half of the year. Like I was talking a minute ago, that we're still getting the wave coming through that we've created, the backlog, if you will, of the last several years coming through, at least during the first half to maybe 3 quarters of 2016. I think we'll still see a pretty strong home building year. In numbers, I'm expecting home building in Houston to more or less keep pace with what it did in 2015.
Good. All right. Well, sounds good. It wasn't too much doom and gloom. That's good. That's good.
The 2017.
Uh-oh. Is that bad news for 2017? Should be good. We want it to get better.
Well, again, that we're still such a large percentage of our Houston economy is based on the energy, the upstream energy. And I don't see the price of oil, despite what you read in some places. I don't see the price of oil coming back to that level that $60, $70 barrel level. I don't see that happening. The best we can hope for is that it will find a reasonable stability point that we can live with on into the next 2 or 3 or 4 years.
All right, sounds good. We appreciate a great update from you for predictions for 2016, Dr. Jim Gaines. We appreciate you coming on and Skyping in from Texas A&M University's Real Estate Research Center. All right, we'll be right back after a word from our sponsors here on Houston Real Estate Radio. Remember, all of the videos from today will be over on the website at HoustonRealEstateRadio.com. So if you missed any of our economic update, you can catch it online. And if you've got a real estate question, you can call us at 844-788-9444. We'll be right back.